This is the IBJ Podcast for the week of Monday, September 9th, 2024, brought to you by Taft. I'm your host, Mason King. Welcome back to the podcast, everybody. This episode will post online on September the 9th, which means that in 9 more days, we will learn whether or not the Federal Reserve will lower its federal funds interest rate for the first time in 4 years. It's quite thrilling. And you, of course, have that date circled on your calendar already. In all seriousness, this could be one of the biggest financial events of the year, leading to lower interest rates for all lending and quite possibly a big bump in spending in the U.S. economy. My interest is on its effect on the interest rates banks pay consumers for parking their money in savings. That interest rate also would go down. Now, to be clear, when I'm talking about savings, I'm talking about money that you want to be able to get your hands on fairly quickly without disrupting your long-term investment strategy. But it's not necessarily the money that you keep in your checking account either. It's relatively liquid. Some people call it cash. You might want to be able to watch it grow, at least a little bit. There are a lot of options for savers, such as passbook savings accounts, high-yield savings accounts, certificates of deposit, and money market accounts. You almost certainly know someone who wants to punt their savings to tangible assets like gold. Each option has advantages and drawbacks, depending on how quickly you want to access your money, how much interest you can get, and the amount of exposure to potential changes in your returns. To be frank, I always have been a money-under-the-mattress kind of guy, but I realize now this is tantamount to hiding your head in the sand while the dessert tray rolls by. So, for this week's episode, I have invited Pete the Planner, aka Peter Dunn, to finally fill me in on this integral element of any investment strategy. Here's our conversation about the Fed's impending interest rate decision and the best places to stash your cash. It is my pleasure to welcome back to the podcast, Pete Dunn, aka Pete the Planner. Pete, how are you? How was Labor Day? What's shaking?
I'm great. Can't wear white pants anymore this year, I think. It's post-Labor Day. Isn't that right?
Oh, wow. What about my seersucker suit? Is that still on the board?
Never goes out of style, never goes out of fashion, even though we're entering autumnal seasons. I heard the word autumnal the other day, and I thought to myself, Mason, I've got to somehow get that into one of my IBJ columns because it's a great word. Instead, I just unleashed it on Your Here podcast.
My 8-year-old will really appreciate that. He loves the seasons. I have 2 concerns today about financial fitness, and they look like, speaking of getting close to the autumnal season, they're about to converge. I wanted to bring you in on my opinion. The first thing to note here is that the Federal Reserve is widely expected to announce on September 18th, barring some kind of calamity, it will lower interest rates by at least 0.25%. I think this will be the first rate cut since 2020. Let's dive into the weeds real quick to explain why this is a big deal. When we talk about cutting interest rates, the Fed actually is cutting what they call the federal funds rate. Is that correct?
It is correct. And I have to express my wild disappointment that as we talked about it being autumnal, you didn't say, and that's why rates are about to fall. And so I'm living in a world of disappointment, but I'll still answer your question.
I backloaded all the puns. It's all in the epilogue.
Okay. Well, great. I'm glad I can be part of that.
Now that you mentioned it, I could have put it in the introduction. You wouldn't even know.
All right. So the Fed believe that inflation is where they want it to be. By the way, I am oversimplifying this.
Yes.
My explanation is slightly reductive, but it is to say inflation is where we want it to be while unemployment is somehow still hanging on to kind of where we want it to be. So now is a good time to cut rates. And that is what we are all on the precipice of. And I think, I don't want to say everyone because that's pretty aggressive. A lot of people believe a rate cut is imminent coming in the next couple of weeks.
Exactly. Yeah. They literally have a meeting where they will announce something about this on September the 18th. So
Quarter point.
You think quarter point. Yeah, I was about ready to say some people, crazy people think it's going to be half point, but it's going to be a quarter point. So the federal funds rate currently, there's a range. It's not actual a rate. It's like 5.25% to 5.5%. It probably will go down 0.25%. The federal funds rate, which I just mentioned, is the rate at which banks loan money to each other. Do I have that right? And the federal funds rate influences the rates that banks charge for consumer lending.
Hey, Wikipedia has steered you well.
It's Investopedia, but yes.
Okay. Anyway, that's exactly right. That's how I would explain it the same way.
So banks lower the interest rates on their consumer loans, then more people likely to borrow money to buy houses and cars or get their bathrooms remodeled or make a big credit card purchase. Good news for the economy. However, when interest rates are lower, that also means banks need to give less interest on savings accounts. We've had a great run on savings, kind of in the 5 to 6% range, I believe.
I haven't seen them get to 6, but 5.5 is where I've seen them get. I'm actively getting 5.5 in a particular account right now. And you are going to see those come down. And, as we talk about where's a good place to put cash, depending on your time horizon, if you're in one of those high yield accounts, like I am at 5.5%, those are going to be one of the first things to fall, and they're going to fall harder than a more moderate yielding savings account.
Okay, we're going to get to these individually in the most boring presentation that I could think of. So interest rates is one of my concerns. The second related concern is a question I've had for my entire adult life. What do I do with the cash that I want to have on hand? Meaning the savings that are not tied up in long-term investments like my 401k or my stock portfolio or my son's 529 plan for college. I'm talking about like our emergency fund and the money that we want to be able to get our hands on pretty quickly, like something saved for a trip or an expensive Christmas present or a down payment on something expensive. Again, the new bathroom. I keep saying that because my wife keeps asking for it. That's what I consider my cash.
Few things. Number one, nothing says celebrating the birth of Christ quite like getting a new toilet. So I think that's an interesting tie-in you have there.
Don't ruin it.
Oh, number two, I'm curious. You say you're concerned about interest rates, and without hijacking what direction you want to go with this, why are you concerned? Are you concerned because the yield on your savings account's about to go down? Like, why were interest rates going down? Why does it concern you?
That sparked my concern. I know, I know the savings rates are going to go down. And then I started thinking, wait a second, I really don't know where the best place for my savings to be. We have savings, and we have savings in a couple of different places. I'm not going to say where, but I really wanted to go through all the options to better understand what might be good for me. Maybe the listeners will get an idea of what's good for them.
Let's do that. But I think there's a really important point here for people that may be in a slightly different situation than you. And that is interest rates falling for some people are the best thing that can happen because they don't have a bunch of money saved. They're looking to borrow money or they're looking to grow a business. So I think the idea that interest rates are falling in a vacuum, it's bad because of the yield we hope to get on our savings accounts. And again, without disclosing your financial life here, when I hear you say that, here's what I believe to be true. I don't believe you plan on borrowing significant money in the next couple of years.
Ever.
Okay. So I think a couple of years and ever will coincide there. I believe you currently don't have a variable interest rate piece of debt that would be impacted by falling rates.
The only thing we have is a mortgage.
Okay. So, and there are a lot of listeners that are in your boat, right? There are a lot of listeners that are like, yeah, interest rates going down for my personal finances is bad because I've loved getting 5%. It's a nice round number. I can do the math. It works really well. I would say that if you don't have debt on the other side of this, if you don't use debt strategically as a tool, and I'm not asking you to borrow money, Mason, then the view you're holding is 100% correct. As a business owner who relies on interest rates, who seeks investment because of interest rates, and I don't plan on borrowing money personally, but our business always has some level of debt facility. This is the best thing that could possibly happen. And I actually don't care about the lower yield on cash position, but it is 100% going to go down, but it's not going to go down 100%.
Well, I love that observation. One of the things going back to 2008 or so, when we were all sort of learning about what happened during the great financial meltdown, I had no idea how much businesses borrowed money on the regular. I mean, sometimes on like a daily basis, and how freely that money flowed from banks.
Absolutely. And then the amount of leverage that's out there, if you think of private equity and you think of venture capital, a lot of times the money they raise is just a portion of the money they invest because they end up investing borrowed money. Yeah. And so when interest rates are lower, then, capital flows freely. I too haven't always understood this, right? And so I'm here to suggest that while we always want low interest rates, I think the more complex idea here is it's actually healthy to have fluctuating interest rates, because in rising interest rate periods, you can theoretically take advantage of it with your cash position and sit on the sidelines a little bit. And in falling interest rates environment, you could take risk if that's your jam, and you can make your money worth more. And so I think the listenership of your podcast is sophisticated to the level of there's people all across the board here, but I think this is just a guess, and there's no way we can verify this unless your email inbox wants to fill up. I believe more people are excited about interest rates falling than disappointed that interest rates are falling.
Yeah, I am obviously super debt averse, but there are a lot of people that we believe are sitting on the sidelines, waiting for September 18th.
Yeah, I will say this. I really like getting 5.5% on my money right now. Like, I really like it. The amount, it's a significant dollar amount. That account goes up every day. I can tell you that dollar amount, but I'm not going to because it'll give you the reverse math. I like it. I like to watch it. I'm going to not watch it when it's at 3.25% a year from now.
So let me circle back. So again, here I am. Let's say I've got $50,000 in cash. This is my emergency fund plus money that we've been saving for a trip and a bathroom remodel. I need to know the best place to put it. I have some ideas. I want to evaluate these ideas in terms of the accessibility of the money, how quickly I can get to it, what the rate of return is, and whether or not I have the ability to lock in a rate of return, whether or not the money is insured or is guaranteed and to some extent, and whether or not I need to make some kind of minimum deposit.
So let me ask, since we are making this hyper personal to you, I'll let everyone else sort of answer their questions rhetorically, these questions rhetorically. Do you believe that your emergency fund needs to be accessible to the second? Do you believe that you need access to the funds, or do you have a credit card or some other facility that allows you to buy yourself at least 24 hours?
I'll be honest with you. I'm such a nervous Nelly that I really do believe that the emergency fund needs to be available like within a day. I have been disabused of that notion by my wife and our financial planner. So the way that we have it set up now, it's pretty easy to get to the money. I'm willing to accept that I can bridge that financing with credit cards.
With at least a day.
Oh, yeah. I'm willing to accept that. Yeah. So, great. CDs are on the table. We'll get to CDs.
I can't tell you how excited I am to know that I'm on your wife and financial advisors team against you. I love that. It's just like this. And by the way, they just gained a tremendous asset on that team. You should let her know tonight.
Oh, yeah.
This is great. Okay. So I think if that's the case, I have no problem personally, because of what I do, having the true emergency fund be in a high yield savings account, getting 5.5%. I don't believe under any circumstance, you have to have money in a regular passbook savings account if you have the means to fund an emergency in the moment. I think very few emergencies require you to have cash in a checking account, and you can always bridge the gap by a 24-hour period with a credit card, right? I don't think you're going to have a $20,000 in the second emergency. I think the chances of that, unless it's like a ransom, I think it's pretty low.
Okay, you're breaking my outline.
I'm breaking your outline.
Yeah, come on, man. Just so people know we don't plan these at all. Here's how I wanted to start. So I am a relatively unsophisticated investor. So when I first think about savings, I think about the savings account that I opened in 1978 at Union Federal Savings and Loan to contain the money I got from delivering the Northside Topics on a weekly basis. And I was getting 5%. And I somehow got it stuck in my head that all savings accounts for all time pay 5%. Of course, this is not the case. But my wife and I do have some money in a neighborhood bank savings account. I looked it up just this morning, and it turns out that we're getting not 5%. We're getting 0.01%.
Okay, so that is a regular, what is sometimes called a passbook savings.
Sure.
It is right now between 0.01% and 0.25%. So again, this $50,000 that we're sort of floating out there, we're talking a few dinners a month at 0.01 versus 5.5. And you have essentially the same level of liquidity, accessibility, and you have at $50,000, you sure as heck have the same level of FDIC insurance. So do I get to tell you on your own award-winning podcast, which you recently won another award for, do I get to tell you that you're wrong and you're doing it wrong? Is that what's happening right now?
Please tell
me. You're wrong. You're doing it wrong. Quit messing up.
Okay, for passbook savings, is somebody out there getting 5%? Because I looked up some other banks and I'm like, no, this is 0.01%.
There are promotional offers, and in whether it is a traditional savings account or they kind of all got different names. Is it a money market account? Is it a high yield savings account? Is it an online digital bank account? To be fair and to be completely honest with you, I at one time only used my passbook savings account as a means to protect money from myself. So I didn't use it, right? If it's in my checking account, you're more likely to use it. If it's your savings account, you're less likely to use it. But then once it gets to a certain balance, it's a little silly that you're foregoing the opportunity that presents itself at 5.5% interest rates for no particular reasons, especially if, man, I'm really piling on to you today. I've only got to send you flowers after this, especially if your perspective is, oh no, interest rates are going to fall. Mason, how are they going to fall from 0.01%? Are you going to have to start paying $80 a month to have a savings account? How do they fall below that?
I don't know.
See, this is awkward. I'm going to possibly owe you an apology when this is over.
Let's take a quick break so we can hear from our sponsor. This is the IBJ Podcast.
Taft, today's modern law firm. With more than 800 attorneys in 8 primary Midwest markets and the District of Columbia, we provide solutions to the business issues facing middle market and emerging companies alike. We do this through a highly collaborative and inclusive team approach. Taft, the modern law firm. To learn more, visit taftlaw.com.
Okay, we're back with this week's edition of the IBJ Podcast and my conversation with Pete the Planner about the best places to stash your cash. So my next question was, what about high yield savings accounts? What are those, Pete?
So it's a bit of semantics, right? They are designed to attract capital. They are designed to get you to their institution. And in some, I don't want to exactly call them a loss leader, but they're meant to get you in so then the bank could theoretically cross-sell other products and services to you. Current rates right now are between 5.02 and 5.5%. Now, what's challenging about this is, if you follow the news, there's a bit of controversy in the last few months about some of these banks that are sort of DBAs, right? They do business as a bank. They're funded by fintech companies, certain types of fintech companies. And so they actually don't have the right level of liquidity or FDIC insurance, but there are plenty that do. And I'll also note the account that I'm thinking of that I have money in, if I were to say have more than $250,000 in it, which is the FDIC limit, it has sweep accounts that actually offers a higher level of insurance. There's a complicated process that allows for that, but it insures money above that. In often cases, I think it's up to $4 million via these sweep techniques.
So where do I get a high yield savings account? Can I just go to my neighborhood bank and go, hey, I just noticed that you guys aren't giving me any interest. Put me in a high yield savings account.
Yes, no. I again, without knowing where you bank and without wanting to know where you bank, because I don't think that's a good thing to do here.
A well-known brand.
Okay. Well,
we call financial institutions brands now.
Yeah, that's true. You're more likely to hear that they've got a money market rate, which is, again,
we're going to get
this conversation too. It's very similar. Money markets are paying slightly less than high yield, but high yield is good, in my anecdotal perspective here, is going to have fewer brick and mortar locations because they have to keep their overhead down so they can potentially offer you a better yield. So is it exactly safe to Google high yield savings account? Yeah, there's nothing dangerous about that per se, but you want to make sure you're at least going with an institution you've heard of. And if you have questions around that and you start to get nervous, you can talk to your financial advisor. If you've got an adult child who's more into digital things, by all means, ask them. But what I don't want people doing is just, how do I get the most on my savings? Clicking on some weird link and all of a sudden you've just sold all your information to someone else.
How easy is it for me to get my money on that high yield savings account?
I can
get my hands on that money.
Days.
Are you literally going to do that on your phone right now? What are you doing?
I thought about, what if I try to institute a withdrawal right now? And let's see. I'm getting 5.5%, not naming names, but again, it's not hard. You just Google who's paying 5.5% APY right now, and you're going to find it. Okay, so here's my cash. What can I do? I can transfer money, withdraw to a connected account. Okay, so this is in real time. By the way, I'm not doing this. I'm going to put $200. I'm doing pretty well. 1 to 3 business days to complete.
Okay. Oh, okay. Great.
Yeah. I mean, again, if it's at the end of a credit card billing cycle, you still got 30 days. So you're fine.
Okay. So you can get to it quickly enough.
I think maybe one of the overarching points of this discussion is to manage money well is to truly understand the relationship of interest rates, how they serve you, whether they're low or high. There's always money to be made, whether they're low or high. They're not fundamentally good or bad. They are either low or high, and you just have to know how to take advantage of it. And that's like you have to know the tricks. There's no tricks. It's just you have to understand that sometimes you can make money by borrowing and sometimes you can make money by saving.
Now, the rates that I would get on a high yield account, they are going to be sensitive to the Fed rate going down. Is that correct?
Yes, you're going to actually see the regular savings accounts, the ones that pay in the 0.01 nothing range. You're going to see those actually less sensitive because there's not much.
Because there's nothing there.
It's like my vertical jump. You cut it in half, you're actually burying yourself in the ground, right? However, with a higher yield, they are much more sensitive. So I'll say this, September 18th, is that the day you said that rate cuts come?
September 18th. I
am anticipating that 5.5, although it is an introductory 3-month guarantee right now. I'm anticipating that rate is going to fall. And it's okay. It's fine. It's fine, but it's going to happen.
Okay. But I mean, if a 1/4 percentage point fall, I would assume is not going to turn your 5.5 rate into a 3.2 rate.
No, I also think it's not going to be point for point. I mean, I think, that 5.5 could turn into 5.15, I think is probably what would happen. But
all that happens in real time, you'll be affected by it.
But there's 2 other wildly important elements here, right, that we can't forget. Number one, it's not like they're going to, they might. It's not like they're going to lower it a point and then just hang out for 180 days and see what happens. Lowering it is part of a strategy to lower it. I mean,
you mean the Fed? Yeah. The Fed intends to go much further than a 1/4 point eventually.
Yeah. A 1/4 point cut begets another 1/4 point cut poetry. And the other element is the presidential election. Okay. And so having this discussion 2 months before an election or whatever the heck it is a bit dangerous is not the word. It's just a bit hairy. All the rules of economics kind of go out the door with uncertainty.
So that takes me to my next class, which is certificates of deposit, which I understand allows you to lock in a particular rate for a particular period of time. Is that correct?
It is. CDs aren't just what we used to listen to music to. They are a certificate of deposits. What was your first CD?
Oh, geez. It might have been Sgt. Pepper's.
Really? No, obviously not a new release.
No. You remember it was like in the early 90s, they re-released all the Beatles albums, I think sequentially on CD.
in case you're wondering, and so people can lose all of the confidence they have in my advice, is Biz Marquis's I Need a Haircut. Hip hop legend Biz Marquis was my first CD. And now I'm a bald man. So go figure how prudent that's been in my life.
Wait, did that have the hit on it?
I Just a Friend? Yes.
You're all that, yeah, Just a Friend, yeah.
Yeah.
Okay.
Anyway, a certificate of deposit is more of a contractual obligation between you and a bank. The bank is contractually obliged, to pay you a particular rate of return over a period of time. It can be as short as a month, or it's usually 3 months is the minimum. 3 to 6 months right now is still paying 4.9 to 5.1%. But I have to say, there's less liquidity in that. Not having access to your money until the end of a 6-month period is much different than a couple day transfer rate out of a high yield savings account. However, and this is where a person's outlook matters, 1 to 5 years is paying between 4.1 to 4.3%. If you think the Fed is going to keep lowering rates, not just in autumnal fall, but if they're going to keep going and going and going, and you think that the yields are going to keep coming down and you want to lock in 4.3% for 5 years, then maybe that's a good investment for you, but you don't have the liquidity you might want.
So here's my observation. It looked like on CDs, just the limited amount of underhanded research that I did, if you stay within a 13-month time frame, you can get something in the neighborhood of 4%. The farther they go, it looked like they were assuming that rates were going to keep coming down. So you could not get as much if you're trying to go for 2 years or 3 years or 4 years.
Yeah, the risk transfers back to you, right? Because I will say, back in the day, when I did have hair and listened to Biz Marquis's I Need a Haircut, so let's say early 2000s, at times, and annuities are much different than CDs, and let's not get into annuities, but there were annuities paying 6% for a guaranteed 6 years. I very specifically remember that. And by the time the end of that 6-year period was gone, interest rates were so much lower that people were freaking out because they couldn't get anything close to that 6% anymore. So there is risk transfer in those longer term contracts.
Here's a question for you. Let's say I just get the super short term CD. I think 3 months is available. The rate that they're advertising, is that an annualized rate or is that for just the 3 months?
It's an annualized rate.
Okay.
To my understanding, it's an annualized rate. But see, that's why I think getting a high yield savings account over the same period offers better liquidity options and a higher rate. So I don't understand the use case for a 3-month CD right now. I just simply don't. Here's the use case. I just found it. What if you, Mason, said September 18th, the Fed is going to cut the Fed rate by 0.75 of a point. Like if you're really aggressive of what you think and you want to lock in this 4.1 for three months, then you would do it. Otherwise, it doesn't make any sense.
I gotcha. That makes sense. A minute ago, you mentioned money markets. We've reached my point in the outline where I talk about money markets. First of all, what is a money market fund or a money market account? What does that mean?
Here's the thing about money market accounts. They are a deposit account in which the account pays interest similar to a savings account, but the money is invested in money markets, which is actually a technical term. It gets confusing, okay? Mm-hmm. I will read for you directly from Investopedia. Money market accounts are regulated under terms similar to ordinary savings accounts. They are insured by the FDIC, and although they may provide checking services, the restrictions of Federal Reserve Regulation D have discouraged their use for day-to-day payment purposes, but they can do what's called break the buck. They can actually fall in value by the nature of how they're created. So not exactly a helpful explanation of what they are.
That's a term I remember from the Financial Meltdown too, breaking the buck.
Yeah, it was the name of my garage band in 7th grade. We were terrible.
And yet somehow omniscient. That's great.
My favorite part about this podcast is that the number of people dismayed and unimpressed by my definition of a money market account will be the takeaway. Like the people are like, wow, that was the dumbest thing I've ever heard.
Here, I'll give you something where you can pile on to me real quick.
Good.
So back in the early 2000s, right, I had a money market fund and it was adjacent or a part of, a brokerage account that I had. When stocks would throw off dividends, they would go into the money market account. And I was getting I was getting 5%. Yet again, I assumed that I would always get 5%. Come to find out 3 or 4 years ago, no, I was getting, say it with me, 0.01%.
Yeah, well, that seems to be.
So that is, the money market doesn't have any kind of fixed rate like a CD would.
You are a magnet to terrible rates. That's who you, like when you go to your doctor and get blood work, there's some level of iron that draws you to bad rates.
Dude, I sold my condo in 2009. Think about that.
So that resonates. Yeah.
Yeah. Oh, okay. So wait a second. So that was 3 or 4 years ago. Now the money market rates went back up, right? I mean, they're currently like 5-ish.
Yeah, they're 5.15 about right now. But they are not, while they are guaranteed from bank failure by the FDIC, they are not guaranteed that they will stay above the buck marker, if you will.
And they're liquid enough that there are sometimes opportunities to write checks on them.
Yes.
But I can do like what you just did with your phone there. You do it, just do a transfer and I got the money somewhere.
Yeah, I do remember back in the day having a checkbook linked to a money market account, but I'm not sure how often people use that anymore. I know people use cash through brokerage accounts. I think they use those sort of instruments, but I'm not sure if it's linked directly to a money market account or some other type of cash account. Don't know.
So is there really a qualitative difference between the money market and the high yield savings account?
I couldn't qualify as to what it is. You would need an actual expert at things. I don't know. I really don't know.
Okay. But you prefer the high yield?
Yes, I do.
So let me throw you a curveball. What about gold? And I say this because I spend a lot of time on financial websites because that's part of my job. Of course, the story popped up saying, hey, the Fed's going to be cutting its rates. Maybe you should look into gold. And it turns out Goldman Sachs counseled its investors in a recent research paper that they should invest in gold as a hedge against what they say are geopolitical and financial risks and in light of the Fed rate cut. Tell me what all that means.
Someone's been watching cable news.
No, I've been reading
gold commercials. All right. So when interest rates go down, gold is a non-yielding asset. So that is to say, you don't get an interest rate. Interest is not paid on holding gold. So interest rates going down don't directly impact gold prices, but they do indirectly affect gold prices because what ends up happening when interest rates fall is that the US dollar becomes weaker against other currencies. And then that is in itself what makes the price of gold change. Gold typically is priced in US dollars, okay? Mm-hmm. So when the dollar does weaken, gold becomes cheaper for investors of other currencies. So actually, dollar weakens, other currencies increase because of that in terms of relative value. And then so that boosts demand for gold, and therefore gold prices go up.
Gold goes up. Okay. How do you buy gold as an investment?
I don't want to say the term most people, but there are sort of a couple different common ways, right? So some people simply buy a gold fund. They will buy a fund of gold, like COMEX. Gold COMEX is a common thing. It's off of the commodities exchange. So far this year, yield to date is 17.53%. and about 22% in the last 365 days. Of course, then you get into other ideas where people want to physically hold gold because they feel that the value is in its tangibility.
Right. You want to have Krugerrands under your bed.
I want to disclose. I don't personally have any relationship with gold. I don't know how to say this, so I'm just going to say I just don't care. I don't use gold as a financial vehicle in my life in the 24 years I've been in it, 26 years I've been an adult.
I at one point, I think, had a gold miners ETF, companies that were involved in the mining of gold.
I have too, but again, it wasn't a gold play per se. It was it's like a hedge, but not like a true gold hedge. I'm not a gold bug. And I know that people that are gold bugs have then converted themselves into crypto bugs. And then you look at all these different hedges of currency and you look at hedges based on what interest rates are going to do. It's just not my world. I'm just not the guy.
All right. Well, I was going to ask you about crypto, but that's not necessarily. If anyone wants to go back to our previous conversations, they'll find all they need to know about crypto. Okay, Pete, we're going to leave it at that. I'm going to just let folks take this information and do what they will with it. Thanks for clearing up so much of this.
No matter what you do, try to not get a 0.01% yielding savings account.
Oh, that's a good thing.
Yeah, we got to have some action point here. I think that it's not for me to program your show, and who knows if I'll ever get asked back. But I would love to talk after the election, because I think that's when some of this stuff's really going to get sorted out. We're going to get an interest rate fall here in the next couple of weeks. October, maybe, I don't know. But by the time mid-November rolls around, we're going to know a lot more about our economy.
That's great. Well, that's good, because that'll be pretty much, I think, when we're locked in for the next one.
And here's the good news. People can then listen to your show, high school students, where they can get their information on economics, because it's no longer a state requirement to take an economics course. So maybe this is just the course they take. It's your podcast.
Yeah, this is the price that I'm paying for not paying attention in econ in high school.
There you go. Yep.
Yeah, this is... I so wish I'd taken Mr. Huckleberry's class, even though everybody complained about it.
Well, I'll be your Huckleberry.
All right, pal. Well, thank you so much. I appreciate your time.
Thank you.
My thanks again to Pete Dunn. A quick reminder, his column on personal finance appears regularly in the print edition of IBJ, and you can find several years' worth of his work at IBJ.com. And before you get on with the rest of your week, there are a few stories in the latest print edition of IBJ I'd like to point out. Number one, finding a water supply for an innovation and research park in Boone County has caused headaches for state economic development leaders, but the project's growing pains have kickstarted conversations about statewide water management that many say are overdue. As Kate Sharon reports, many stakeholders believe failing to act soon could threaten Indiana's economic growth. Also in this issue, Daniel Bradley has an in-depth look at Republic Airways' new corporate campus in Carmel and its 105,000 square foot training center. And Taylor Wooten examines how Indianapolis officials are now approaching the perennial challenge of funding street maintenance. And again, you can find these stories in the latest print edition of IBJ or online at IBJ.com. I will say it is quite a bit easier to access all of the latest business news and all of IBJ's data on Central Indiana's business community and economy if you're a subscriber. We're running a promotion right now that gives you complete access for $1 per week for 3 months, just to get a sense of how valuable and original our content is. Just go to IBJ.com and click on the subscribe button. And thanks again for making time this week for the IBJ podcast. I'm Mason King. Hang in there, everybody. We'll be back again next week.